Today, we are exposing one of the most overlooked dangers in real estate investments and how it has put buyers at risk. Imagine buying a fully completed property, only to discover that the developer who sold to you had the right to sell. Not because the property is fake, but because of a joint venture agreement you never knew about. Welcome to Encumberedproperties.com, the only real estate fraud prevention platform. Please stay with us. You're welcome back. Meet my guest, Mr. Madueke Enwere, a very senior police officer and a property lawyer. He is not a new face on this platform for those of you who have been following us for a long time now. But if you're joining us today for the first time, you're highly welcome. Thank you so much for showing up.
Thank you, Rex.
It is my pleasure. I really want us to talk about something very important, an aspect of the real estate investment of today that I would want us to talk about: joint venture property development. So what exactly is joint venture property development? And why is it rampant in today's real estate market, especially in Nigeria?
Joint venture real estate development or investment is a kind of property development where we have two key players, a landowner and a developer. A landowner is volunteering his land, whereas the developer is volunteering funds, technical know-how towards improving on a piece of land. So that is where you see the margin of the two people. That's why it is called joint venture. That's why it's called joint agreement. And the rights of the parties, what they can do, what they cannot do, are all detailed in what we call JV agreement, joint venture agreement. And the second lap of your question asks, why is it that this kind of relationship
Is rampant.
is becoming rampant, especially in Nigeria? It is not really far-fetched. Joint venture property development agreements are becoming rampant because of its economic reasons, purposes.
Okay.
Take, for instance, a landowner. He has an undeveloped plot of land. He doesn't have the money to go into its development. Instead of going to the banks to borrow capital at a very high interest rate, he goes into an agreement with a developer who has the funds. Instead of the developer depleting the capital he has by going to buy a land to develop, he saves that money he would have spent buying a land and plunges it into development itself. Take, for instance, I'm a developer in Abuja and I have starting up capital of, let's say, 700 million naira, and I want to develop, let's say, 2,000 square meters of land in a developing neighborhood. Say Jahi, 2,000 square meters in Jahi will be selling for not less than, or within the border of close to 500 million.
Okay.
In a good neighborhood, average of 500 million. And let's say I have 700 million naira. If I, as a developer, out of 700 million, I buy an empty plot worth 500 million, I have barely 200 million naira left. And you know how far 200 million naira will go into developing a 2,000 square meters of land. It won't take it to foundation level. It will barely come out of foundation level.
Right.
After obtaining all the necessary approvals and all the preliminary expenses. So it is wisdom. I partner with someone who already has a plot of land. He doesn't want to sell outrightly. We agree on a sharing ratio after development. I can guarantee you that if I prudently manage my 700 million naira, developing 2,000 square meters of plots in Jahi, that 700 million naira would virtually almost bring that project to completion.
Okay.
So that is why landowners who don't have money to develop are now partnering with developers who have money to develop. You now see a win-win situation. The landowner benefits. He doesn't sell his land outrightly and lose everything. The developer benefits. He doesn't use his capital to buy an empty plot, and he will be left with nothing to start development. That's exactly why a lot of people are waking up to the benefits of joint venture property agreement. And that's why it is becoming rampant everywhere.
All right, thank you for that. Over time, we've seen financial disputes arise from joint investments. So I would want to know, how are developed properties shared between the landowner and the developer? Also, are all joint venture agreements, structured the same way, or there are variations? I would love to know.
There are so many things that could cause or bring about disputes. In as much as joint venture property agreement is very attractive for its immense benefits, it is also very dicey. One of the reasons for friction is where the terms and conditions are not well spelled out. In such a case, there is bound to be a disagreement. Take, for instance, in a joint venture agreement, it is stipulated that this property will be developed within a period of 24 months. In other words, binding the developer that within 24 months he is meant to deliver from start to finish without taking recourse to the period it will take to get all the necessary approvals from the relevant development control agencies, FCDA, as the case may be. And in the process of getting the approvals, the developer spends probably 3-4 months before he gets the approvals, and it wasn't figured into the agreement. You can see that the time limit is already being eaten into by this time frame it took development control to give all the necessary approvals before the developer could move to site. So this is one of the salient or very important areas some overlook. So when the terms and conditions are not well spelled out, you find the parties running into trouble. You also asked whether the terms
are structured the same way or there are
structured the
variations.
same way. Particularly, I want to talk about sharing ratio. That is one key area that brings about friction. It is not always structured the same way. Okay. In some cases, you see parties agreeing that after development is completed, the parties will share 50-50 the completed structure. The parties will share 40-60.
Okay.
That is, the landowner 40% of the developed structure, then the developer 60%, as the case may be. In some other cases, you see a situation where it will be agreed that the proceeds, in other words, the property developed will be sold and the proceeds harnessed together and shared according to agreed ratio. Now, situations are as well where the parties will agree that the developer develops and manages the property for a particular number of years,
okay,
recoups his investment and interest,
okay,
and the property reverses back to the landowner.
Okay.
Let's say 25 years, 30 years,
okay,
35 years, as the case may be. In this case, the developer has no right to sell. In this case, the developer can only use the property, manage the property, lease the property, rent the property for that number of years, and after which he hands over possession back to the landowner.
Well explained. I want to know, at what point does joint venture agreement become a risk to an unsuspecting buyer?
Joint venture property development agreements, they become a risk to unsuspecting buyers where a buyer, for instance, gets satisfied with knowing that this property, the title to that property is legit.
Okay.
They provide you with letter of allocation, right of occupancy, or C of O. You verify, yes, this allocation letter is attached to this property and it is legit. It is genuine, and you go ahead and pay without studying to know the details of the relationship between the developer and the landowner.
Okay.
You fail to find out whether the developer has right to sell. If he has right to sell, how many units is he entitled to sell? Can he sell before completion? You fail to find out whether if the developer is only meant to manage, recoup his investment and hand over. So a situation where you fail to find out and a fraudulent developer, a dubious developer, decides to sell where he's not supposed to sell. A developer probably is entitled to 50% and he markets beyond 50% of the property. You should be able to confirm from the landowner that the unit being sold to you is actually owned by the developer. Another risk to an unsuspecting buyer is a situation where the JV agreement says the developer manages over a period of time and the property reverses back to the landowner. And without the buyer looking at the terms of the JV and buys any part of the property from the developer, that will mean if the developer is meant to manage it for maybe 30 years, after 30 years, the landowner will show up and, have issues or would want to check out the person who bought from the developer.
So what happens to the unsuspecting buyer?
Well, that's where due diligence becomes very important. Due diligence doesn't start and end with confirming that the title to the land is genuine. If it is a property developed under joint venture, you are bound to read in between the lines all the clauses binding the developer to the landowner. owner. A situation I experienced.
I was going to ask you if you could share a scenario with us.
A joint venture development somewhere in Dakibu here.
Okay.
I was interested in buying a unit. I think 6 units of terraces. I was told by the developer that okay, part of the units belong to the landowner, another end belong to the developers. I think 5 units, 2 from this side, 2 from the other side, and the middle units they would sell and share the value. I think 50-50 JV. So I indicated interest in a unit, the one that is at the end.
Okay.
I indicated interest on the corner piece to the end. They said sold. The next one sold. Then the corner piece at the beginning, they said I could take it. I was like, but you told me that this is shared this way. So why are you not telling me that I could pay for the one that belongs to the landowner? So this was one of the red flags. Most developers, their own is to tell you anything that will make you bring out money. When the chips are down, it would have become too late for you to get back your money. So it becomes important that you look at the details of the JV agreement before depositing your ₦1 with any developer.
From what you said, it's important for anyone to look out for the joint venture document before partnering with their money, right? So why do most buyers, even agents, overlook this important document?
It's ignorance. If you are getting into property deal for the first time, you just see a developed property and you are interested, you want to buy and all that, you might not know where to start. That's why I have actually taken my time to put together 7 steps to acquiring a clean property title, a practical checklist. It starts you as if you have done real estate business, over and over. The over 20 years of experience is encapsulated in those actionable 7 steps. When you grab a copy and you begin to bargain with any real estate developer, they will be careful with you because you will be speaking from the point of knowledge.
What practical steps should a buyer undertake before keying into any property under joint venture development?
One of the things I mentioned already here is that you must demand to see the agreement, the JV agreement. You read it for yourself, interpret it for yourself, understand it for yourself. That is 1. 2, always make sure you visit Encumberedproperties.com. It's a platform where risky estate offers are flagged on daily basis. It will enable you to know whether the property you're about or negotiating to buy is flagged, risky, encumbered, or disputed. If you arm yourself with all these 3 steps, all these 3 items I mentioned, I tell you that you are cruising to making the best real estate investment that will land you in
For someone who is just starting in this real estate investment business, a lot of pitfalls already. So what would be your first take advice for someone who comes up to you and say, as a property lawyer, you've been into this for over 20 years, I want to invest in real estate, I need a one take-home advice? What would be your take-home advice for that person?
The take-home advice I would give to any first-time investor is never to rush, but to follow this platform, gain insights that will help that person make the best real estate investment, because knowledge is what secures your capital. Everybody's buying, everybody's investing. You rush without having the requisite knowledge, you are most likely going to lose your first capital. So I would encourage anybody to follow this platform, digest the tips over time, and I tell you, the knowledge you get from this platform will equip you to making the best real estate investment ever.
Thank you so much, Mr. Madueke. Well, it was indeed a sweet time for me. I truly do appreciate your time and insightful contribution.
Thank you so much.
And to you, our viewers, thank you so much for staying tuned. In case you're joining us, you're watching Encumbered Properties, Buyers Beware Red Alert. And today we talked about one of the dangers in real estate investment that most buyers ignore. I believe by listening to Mr. Madueke, a property lawyer, you must have learned 1 or 2 things. Till I come your way again, stay safe and stay out of trouble. My name is Rex Chinedu Agwawike. We love you and we care about the safety of your real estate investments.